Okay guys, today we're going to talk about accounting for a merchandising business, and we're going to see that it's a little more complicated than accounting for a service business. So in a service business, everything was pretty clean cut. We had fees earned, which was the revenue that we received, or I'm sorry, I should say the revenue that was earned. Remember, under the accrual basis of accounting, we record revenue when it's earned, regardless of when the cash is actually exchanged. So we started with our fees earned. From that, we subtracted out our operating expenses, and those are the expenses that are part of operations, of course. And once again, under the accrual-based system, we record expenses when they're recorded, regardless of when we actually pay for them. The difference between all of the fees that we earned and all of our expenses is our net income. That's how profitable we were for that period of time. And if our expenses were more than our revenues, then we would have a net loss. Merchandisers have something called inventory. And inventory are those items that they purchase to resell. Inventory is an asset until it is sold, and at that point it becomes cost of merchandise sold. So this is the typical format for the income statement of a merchandising business. We have our sales from selling inventory or selling products. We have the cost of the merchandise sold, and that gives us a little subtotal here called gross profit. And from gross profit, we're going to subtract our operating expenses like utilities, wages, property taxes, and things like that. Okay, so this is a little bit redundant right here. And so take note, once again, merchandise on hand that is not sold at the end of an accounting period is called merchandising inventory. Many times our accounting period is going to be a year. Sometimes, just for management purposes, a company might want to see financial statements prepared on a monthly basis. Let's speak quickly here about the perpetual versus a periodic system of maintaining inventory. So the main difference is, with a perpetual system, we make an additional journal entry with each time we sell an item of inventory. So at any point in time, we should know how much inventory we have on account. We keep track of how much we've purchased, and with every single transaction, like when you go to the grocery store, when they ring things up at the register, not only are they determining how much you owe them, but they're also keeping track of how the inventory is flowing out of the store. So if they start to get low on some inventory, they can replenish it. It's a bad thing for a company to lose money because there's no inventory and people want to purchase that inventory. So the perpetual system is used nowadays with many companies, and with technology being the way it is, it makes it very easy to maintain. Now this is different under the periodic system that we're going to talk about now. And so it says here in the periodic inventory system, sales are recorded as they occur, but we're not going to make that second entry to show the outflow of inventory when sales take place. Instead, we look at the amount of inventory that we had at the beginning of the accounting period. We look at what we have left at the end. The difference between those two is the amount that it's going to be our cost of goods sold. Kind of the same way when we were working through supplies. We looked at the supplies we had on hand. We added to those any supplies that we purchased, and we looked at the end of the accounting period at the amount of supplies that we had left, and in that example, the amount of supplies that were missing we called supplies expense. Now, regardless of what inventory system is used, it's good practice to perform a physical inventory count at least once a year. So under the perpetual system, we do keep track of all amounts of inventory that come in and go out. But believe it or not, sometimes people steal from businesses. So that was a joke. It happens all the time. So we need to perform a physical count to see if there's a difference between what our accounting records show for inventory and what actually is on hand. Okay, so here is an example. This is using Net Solutions here, and this is an example income statement for the year ended. Remember, our income statements are for a period of time. We have our sales, we have our cost of goods sold, and that leaves us with our gross profit. So companies, retailers have to mark profit up considerably because from this gross profit we have to subtract out all of these selling expenses and all of these administrative expenses. That leaves us with income from operations. And notice we're going to categorize things like the depreciation expense on office equipment under administrative, whereas we're going to take things like depreciation expense related to the store and selling, and we're going to categorize those under selling expenses. Many times different managers are responsible for this area versus this area, and it makes it easier to know how well they're managing their division, if you will. So we have total income from operations at this point. This is not net income because we have two kind of oddball things down here. We have rent revenue and we have interest income. Now, rent revenue comes from us renting out some property that we have. And just think about it this way. What if we have two companies, let's say there's another company similar to Net Solutions, and their financial statements are almost identical because they've been performing in a very similar way, but one of them happens to have rental income coming in from property that they might have, and maybe it's a significant amount. Maybe it's like, $36,000. Well, that's going to make their net income higher, but it's not because they're doing a better job doing Net Solutions type work or tech support, but instead it's because they have this other thing that's not related to their core business. Okay, so that's why this goes into this other income area. And interest expense, that's another example, and that comes from whether or not a business chooses to borrow money or if they choose to sell ownership to raise money. We're going to save that topic for a later point, but for now just know that anything like rent revenue or interest expense are going to go into this other income and expenses section. There's nothing different about our statement of retained earnings. Once again, we take our net income that we had from the previous slide there, $75,400, and we're going to add that to the beginning balance. We're going to subtract out whatever dividends we might have, and that's going to leave us with our ending retained earnings. This number is going to be plugged into the balance sheet, not this number up top here, right? This was at January 1st, 2017. This is at December 31st. This is the date that we're using to prepare our financial statements, and so this is the number that we're going to want to make sure that we use. Now let's take a look at the balance sheet. So once again, remember 186,200, 186,200. Here it is plugged in right down here at the bottom. Now remember, this is going to be our classified balance sheet, so we have our assets listed in the order of liquidity, cash being the most liquid of the assets. Then we have property, plant, and equipment, and that's going to be, of course, our property, like land, our equipment right here, and our factory building or anything like that we might have. When we add all this stuff up together, we get our total assets. Now we know our total assets have to equal our total liabilities and total owner's equity. If they don't, then we know we have a problem and they do not balance. Remember, these two guys have to always balance. And most of the time people accidentally plug the beginning number for retained earnings in right here, so make sure you have not made that mistake. Okay, notice up here there's a difference. So we haven't seen this before in a classified balance sheet. This is merchandise inventory. Remember, inventory that is unsold, so this is unsold inventory as of December 31st, 2017, is going to be recorded as a current asset. The amount that was sold shows up on the income statement as cost of goods sold. So if we had $100,000 worth of inventory to sell at the beginning of the year, and let's say maybe we purchased $50,000 more of inventory, that gives us $150,000 of inventory that's available for us to sell throughout the year. If at the end of the year we have $125,000 of inventory left, that means that $125,000 is going to show up on the balance sheet as merchandise inventory, and the other $25,000 would have been sold. And once again, we can either use the perpetual or the periodic system to determine what has been sold, but it's very important that at some point each year we do some type of physical inventory count. It's necessary with the periodic system, otherwise we can't figure out how much we've sold, and it's good for the perpetual system to help us identify how much is missing via something we call inventory shrinkage. Inventory shrinkage is when the amount of inventory that we have when we actually count it up is less than the amount we have in our accounting records. Typically it's going to be less because last time I checked, when you see people rioting, they aren't bringing TVs and things into a store. Things are typically walking out of the stores, right? So that's it for now for Chapter 5, at least with respect to the introduction and the differences in the classified balance sheet. Please let me know if you have any questions.